What if the most powerful economic shift of this decade didn't happen during a crash, a war, or a crisis, but quietly, methodically, while the world was distracted by headlines designed to pull your attention elsewhere? Most people believe that global power changes through dramatic events. Wars, collapses, shocking announcements. But history shows something far more unsettling. The biggest shifts usually happen slowly, invisibly, and long before the public realizes what has changed. That is exactly what is unfolding right now beneath the surface of the global economy. While news cycles focus on political drama, elections, trade disputes, and surface-level conflicts, China has been executing a far more consequential strategy, one that does not rely on military confrontation or diplomatic spectacle. Instead, it relies on patience, scale, and control over something far more fundamental than policy or rhetoric, physical resources. This is not a theory, it is not speculation, it is not fear-based storytelling. It is a documented, observable strategy backed by trade data, acquisition patterns, industrial policy, and years of coordinated execution. Once you recognize the pattern, it becomes impossible to unsee. And when you understand the implications, you realize why this matters not just for governments, but for your savings, your investments, and the currency you rely on every day. China is no longer simply the world's factory. That description is outdated by decades. Low-cost manufacturing was only the first stage. What has replaced it is something far more strategic. China is positioning itself as the gatekeeper of the materials that make modern civilization function, the materials that power technology, energy systems, transportation, defense, medicine, and communication. Control the materials, and you don't just participate in the global economy, you shape it. Every advanced industry depends on a relatively small group of critical inputs. Semiconductors require highly specific metals. Renewable energy depends on rare earths and conductive materials. Electric vehicles need lithium, nickel, cobalt, and copper. Military systems rely on specialized alloys and precision components. Medical technology requires metals with unique chemical properties. None of these systems function without reliable access to raw materials. China understands this reality deeply, and instead of competing at the finished product level alone, it has been quietly moving upstream toward the foundations. This is not random buying. This is not opportunistic speculation. It is a coordinated state-backed effort involving state-owned enterprises, strategic financing, and long-term national planning. The objective is simple: secure supply, reduce vulnerability, and gain leverage. Look at what has been happening across global commodity markets. Chinese firms consistently outbid Western companies for mining rights in Africa, South America, and Central Asia. Processing infrastructure has been concentrated domestically. Imports of key metals continue rising even during periods when domestic manufacturing growth appears flat. Strategic reserves are expanding, often quietly, with little transparency. Rare earth elements offer one of the clearest examples. China already dominates global processing capacity. Even when rare earths are mined in other countries, they are often shipped to China for refinement because the infrastructure and expertise exist there. This creates dependency. And dependency is power. These materials, neodymium, dysprosium, terbium, and others, are essential for electric motors, wind turbines, missile guidance systems, advanced electronics, and medical imaging. Without them, entire industries stall. Control over processing means control over availability. And China is extending this model across the industrial spectrum. Platinum group metals for electronics and chemical processes, copper for electrification and infrastructure, lithium for energy storage, nickel and cobalt for battery stability, tungsten for industrial tooling, chromium and molybdenum for high-strength alloys, gallium and germanium for semiconductors and fiber optics. The list is long, and the pattern is consistent. This is strategic stockpiling on a scale rarely seen outside wartime. But there is another layer to this strategy that is even more consequential: currency. Every time China purchases physical resources, it is converting financial reserves, largely held in US dollars, into tangible assets with intrinsic value. For decades, China accumulated massive dollar reserves through trade surpluses with the West. Those reserves represented claims on a system increasingly dependent on debt, leverage, and monetary expansion. Instead of continuing to recycle those dollars endlessly into Western bonds and financial instruments, Beijing has been methodically exchanging them for physical assets that retain utility regardless of monetary policy. This is not just diversification. It is a transformation of stored wealth. Paper claims are being exchanged for industrial foundations. Ask yourself a simple question. If you held vast reserves in a currency that is being continuously diluted, what would you do? Would you hold the paper indefinitely? Or would you convert it into assets that maintain value and provide strategic leverage? China chose the second option and has been executing it with discipline. Trade tensions and tariffs have only accelerated this process. Reduced trade flows mean fewer new dollars entering China through commerce. Rather than panic, China adapted. Trade settlements increasingly occur outside the dollar. Alternative financial infrastructure is being built. Existing dollar reserves are being deployed aggressively into resources before further devaluation occurs. This shift has consequences for the global monetary system. The US dollar is not merely fluctuating. It is undergoing a structural decline. This is not about short-term sentiment or temporary market moves. Structural dollar down cycles, driven by fundamental changes in trade and reserve behavior, historically last for years, and we are likely still early in that process. Currency markets already reflect this shift. The dollar has weakened significantly against major currencies. Options markets show heavy bearish positioning. These are not casual bets. These are institutional signals. At the same time, another major force is emerging: Japan. Japan's central bank has begun raising interest rates after decades of ultra-loose policy, yet the yen remains weak. Import costs rise. Inflation pressures build. The Bank of Japan is now forced to prioritize currency stability despite carrying one of the highest government debt burdens in the developed world. With debt approaching 250% of GDP, higher rates create enormous strain. Servicing costs rise. Fiscal flexibility shrinks. To defend the currency without collapsing public finances, liquidity must come from somewhere. The most obvious source is foreign asset sales, particularly U.S. Treasury bonds. Japan is one of the largest holders of U.S. government debt. Even modest selling pressure can ripple through bond markets, pushing yields higher and weakening dollar demand. But that is only part of the story. The larger issue is the unwinding of the yen carry trade. For years, investors borrowed yen at extremely low rates and deployed that capital into higher-yielding U.S. assets. This trade funneled enormous liquidity into American markets, supporting asset prices and suppressing yields. But the trade only works when Japanese rates remain low and the yen remains weak. As rates rise and currency risk increases, the math breaks down. A strengthening yen turns borrowed capital into a liability. Repayment costs rise while asset values fall. Losses compound from both sides. At that point, the rational response is exit. As this carry trade unwinds, capital flows reverse. U.S. bonds face selling pressure. U.S. equities lose support. Dollar demand declines further. These forces reinforce one another. Now layer this on top of what is happening in commodity markets. Silver provides a highly visible case study. Prices have surged dramatically, far beyond historical norms. This is not just speculation. It is a collision between constrained supply and accelerating strategic demand. Silver is no longer viewed merely as a monetary metal. It is now classified as a critical industrial input. It is essential for semiconductors, solar panels, defense systems, aerospace technology, medical equipment, and electrical infrastructure. Demand is rising across multiple sectors simultaneously. Supply is not. Mining output cannot keep pace. New projects take years to develop, and competition for available metal is intensifying. In China, this has produced extreme behavior. Investors have recognized the fragility of paper markets where dozens or even hundreds of claims may exist for each physical ounce. When trust erodes, the logical response is to seek delivery. Physical demand has exploded. Funds have become oversubscribed. Premiums have detached from underlying value. In some cases, investors have paid extraordinary markups simply to gain exposure. This behavior is risky. It reflects speculative excess. Corrections are inevitable, but it also reveals something deeper: fear of future inaccessibility. Local prices in China have diverged sharply from global benchmarks. Arbitrage mechanisms have failed, not because traders are unaware, but because physical supply cannot move freely. Constraints override financial logic. Silver is not unique. The same dynamics are unfolding across industrial metals. Copper inventories tighten. Lithium demand accelerates. Nickel and cobalt markets strain. Rare earth supply chains consolidate. Strategic materials are being absorbed, not traded, month after month, year after year, quietly. This is modern resource competition, and it lacks spectacle, which is why so few notice it. Whoever controls critical materials controls manufacturing access. Whoever controls manufacturing access controls innovation. And whoever controls innovation shapes the future economy. Time favors those who move early. While Western institutions debate policy and form committees, positions are being secured. By the time responses materialize, supply chains may already be locked. Every ton of material acquired represents another conversion of currency into leverage, another reduction in dollar demand. Thousands of individual transactions compounding into systemic change. Looking ahead, these forces converge. China converting reserves into resources. Japan adjusting policy and potentially selling foreign assets. Carry trades unwinding, trade settlement diversifying. Strategic stockpiling increasing globally. This is not a normal cycle. This is a structural reconfiguration. The post-war financial system is being challenged, not through confrontation, but through patience. For individuals, the implications are profound. Assumptions that held for decades may no longer apply. Currency stability cannot be taken for granted. Diversification must extend beyond financial instruments. Physical reality matters again. This does not mean panic. It means awareness. Periods of transition reward preparation and understanding. They punish complacency. The real question is not whether change is happening, but who recognizes it early enough to adapt. Because this story is not ending. It is just beginning.